Hello, it's a pretty lovely but yet again a bone-chilling evening from here in Delhi, but still we are going to welcome you with greatest of warmness. So this is going to be the second session as far as India's 103 is concerned, correct consolidated financial statement. In the last session, we have had a good look over the initial conceptualities, and I'm very sure, and appearing from your comments, it seemed actually each one of you really liked the session. And that is exactly what we intend, and that's exactly the purpose behind what we got taking up uh, such deeply intense classes. Correct? So looking forward to have your messages and lovely good evening. And green signal is also on. Lovely good evening to those who have just connected with us now. And this is the second session as we are going to start today. And hope that now each one of you are having the books or the notes with you. And if you have that, kindly open the notes and the books. Correct? So, as you must have seen, as far as this particular chapter is concerned, we have divided it into 15 sections, 13 sections, sorry. And besides that, as usual, I'm going to do some additional questions. In the meantime, as I talked in the last session, correct? Thank you very much. Thank you very much, Shikha Gautam, for such comments. Such comments actually gives us tremendous amount of zeal, tremendous amount of enthusiasm, and your such love and affection is a great factor in what we call giving you the best shot. Correct? So now coming directly to the business end without wasting much time, already it is 32 past 8 now. So we are now starting the session. Lovely, lovely good evening. Once again, now please, we can directly come to the business end as I said. So question number 1, this is section 1. In section 1 itself, nearly we have kept 20 question, I think so. In section 1, now we are moving over to, so kindly open if you have the books. Even if some of you might not be having the books or notes, you need to require to worry. But my advice is, if some of you haven't actually still bought the books, kindly do it at the earliest. Correct? This is my only piece of advice. So section 1 is full length question. 1.1 you are going to do it of your own, because we are going to start today with the session, this particular session, with question number 1.2. So if each one of you are absolutely ready, then we on our part as usual are ever ready. So here we go and start this particular session, and I hope that each point you are still having what we call in your memory, which we discussed in the last session. So 1.2 is the question with which we are beginning the session. Here we go. The extract of the balance sheet of P Limited and S Limited as on 31st of 3 2022 is given. Correct? Last time, if you remember, I did talk about this particular fact that whensoever you are going to actually prepare the consolidated balance sheet, it is important. In fact, it is imperative for you to note down what we call at least the 3 important things: the investment, the share capital, and besides the face value. So as far as this particular question is concerned, here in this particular question, we are being given under what we call non-current asset. First of all, tangible asset. And under the tangible asset, property, plant and equipment is given, as you can see, 10 lakh and 8 lakh. And later on, as you must have seen, when we are going to prepare the consolidated balance sheet, this particular item will be simply added in a line by line manner. Correct? Now coming over to this particular item, investment. Nowadays, investment is categorized as financial asset. It could be under non-current asset. It could be under non-current asset. Remember one thing, the balance sheet mostly which are given in the question are as per division 2. If you remember, if you have gone through that session which I recently took actually, India's introduction, over there I talked about what we call division 2. So because we are dealing with India's, and all such companies which deal with India's need to prepare their financials as per what we call division 2. So under division 2 we write assets first, and investment nowadays comes under the category of financial assets. Investment in 3,000 equity shares in S Limited, this time amount paid is 7 lakh. Correct? Besides that, we have current asset 5 lakh and 11 lakh. Unfortunately, last time when I did that particular example, I think I wrote the amount of current asset incorrectly, so kindly correct it. Correct? Some of you actually pointed it out, and it is nice of you. Equity and liability. Coming over to equity. as far as share capital is concerned, face value 100. This is another important point which you need to take into account. Share capital of P Limited is 10 lakh and share capital of, as I said, subsidiary company will play a pivotal role later on, 5 lakh. In fact, if number of shares, I would ask of you, it will be 5 lakh divided by 100, that is 5,000. Then profit and loss account. Other equity item, as you must have seen, also play important role as far as of subsidiary company. So at the end of the year, we may say that subsidiary company is having profit and loss account balance of 5 lakh. Is it clear to you or not? I hope that most of you are now having the books or the notes with you. And then we have been given non-current liability, 5 lakh, 4 lakh, line by line addition would be needed later on, 3 lakh, 5 lakh, we will simply add them. Now in this question and the question which we did last time, the only difference is that in the last question, the date of acquisition was in the beginning, and here we are taking when date of acquisition is not in the beginning, rather during the accounting year. Correct? For example, in this particular case, it is given to you that P Limited acquired the shares in S Limited on 30th of 9, 2021. Is it clear to you? And profit and loss account balance of S Limited is stood at rupees 2 lakh in the beginning of the year. The profit and loss account balance of subsidiary company in the beginning of the year is given. So, what are the points which we need to take into account while solving the question? I just told you, one is investment. You must consider also the amount which you have paid, because later on you will have to compute the amount of goodwill wherein you would require the amount of consideration. So, this 7 lakh will become the amount of consideration. Besides that, the face value, and of course the share capital of the subsidiary company. So these are the things. And besides that, of course, the other equity item of the subsidiary company, their closing balance and their opening balance. So these are the things, if you are going to keep in your mind, then definitely it becomes pretty easy to handle such things. So now here we go and start solving this particular question. Correct? Because these are initial questions. Even though the questions, each and every question has been given in a solved manner, is still my advice, for God's sake, correct? Kindly note down the things, correct? Because that will help you a lot. So here we go. Now kindly actually tell me, in between I am going to test you also. So far we have received only one messages from the YouTube members, whereas hundreds of messages are flashing down on SAS. What happened? Are you there or not? So 1.2 is the question which we are beginning with today. And as usual, in the last session, I talked about this particular fact that first of all, we are going to do the analysis. If you remember, analysis. This is the first and foremost thing. And some of you might be thinking, sir, it is a wastage of time. Actually, why you are doing all these things? I know some of you might be feeling that way around. But anyway, we start the session now. And here we go. I stretch a line as usual. First of all, I'm going to take into account the closing date. The closing date in this particular question is given to us 31st/3/2022. And then we are going to note down the opening date. The beginning of the accounting year is 1/4/2021. Besides that, we just noted down, below it was written that date of acquisition in this particular question you must have seen was 30th of September. 30th of September 2021 was your date of acquisition. If this is your date of acquisition, then what about the entire during the year period? During the year period means the period which starts from the beginning date and ends at the end date. This is entire during the year period. Now this time, out of these 12 months, we can safely assume that first 6 months are of pre-acquisition nature and next 6 months are post-acquisition. Is it clear to you? Yesterday, I mean to say in the last session, we talked about this particular fact that the period which falls preceding the date of acquisition is known as pre-acquisition period, while the period which falls later, that is after the date of the acquisition until the end of the year, is known as post-acquisition period. After this particular point, what we are supposed to do? After this particular point, as I told you in the last session, that we need to compute the degree of control. DOC in short form I have written. You can also write controlling stakes. In order to compute this, only thing we require is number of shares of the subsidiary company. Now, as far as number of shares of subsidiary company are concerned, I just, while going through the question, told you that their share capital is 5 lakh. So I'm going to write here 5 lakh and one share is of 100 each. So that means as far as subsidiary company is concerned, their number of share is equal to 5,000. Is it clear to you? Out of these 5,000 shares, we have already seen that held by P Limited is equal to how much? Now, held by P Limited is 3,000. Under the investment it is written, isn't it or not? So it means the shares held by other shareholders known as NCI. So NCI share in this case will be equal to 2,000. Similar to the last question, we may say that even in this particular question, controlling stakes are 3:2, that is 60%, 3/5 or 2/5 or 60% or 40%. Having computed this one, what should be our next step? The next step, as I told you in the last session, analysis of other equity items. So now we are going to do the analysis of other equity items of subsidiary company, other equity items of S Limited. Although we need not require to write other equity items of subsidiary company, we can simply write analysis of other equity. Now, in this case, as far as other equity concerned, only one item is given, and that is profit or loss account. So we are going to now analyze it. The basic purpose and the idea behind what we call analyzing is to know what amount of profit which subsidiary company earned during the entire accounting period relates to the pre-acquisition period, and of course what portion relates to the post-acquisition period. So in order to segregate that, first of all, I will write the closing balance. In the balance sheet, we marked out especially the closing balance, if you remember, of subsidiary company as far as profit and loss account is concerned. I think it was 5 lakh. Please keep an eye over the figures. Generally, when I solve the question, I don't keep the question in front of me. Reason being is that they are mostly actually memorized to me, but still that is the reason actually why I'm asking you to keep an eye over here also. In case if I inadvertently commit a mistake, kindly bring it to my notice. So 5 lakh is the closing balance, and in this case our opening balance is 2 lakh. Opening balance is 2 lakh. If opening balance is 2 lakh and closing balance is this much, how much profit subsidiary company must have earned during the accounting period? In order to know that, you will have to simply take the difference of these two, as I told even in the last session. So difference comes to, I think, 3 lakhs. So that means during the entire accounting period, subsidiary company must have earned a profit of 3 lakh. And if you remember in the last session, I told you we should not stop at this particular point. Rather, this entire profit which has been earned by subsidiary company need to be segregated into pre-acquisition part and of course the post-acquisition part. And in this particular question, as we have just seen, that first 6 months relates to pre-acquisition period. So in this case, out of 3 lakh, we may say that subsidiary company must have earned this much in the pre-acquisition period, that is 6 lakh into 6 by 12. And that makes it 1,50,000. So 1,50,000 is the profit earned by subsidiary company in the first 6 months. We can safely now conclude. And likewise, as far as post-acquisition period is concerned, in this case, because post-acquisition period is also of 6 months, so we may say that in the next 6 months, that is after the date of the acquisition, subsidiary company earned a profit of 1,50,000. Isn't it or not? I hope till up to this particular point, things are absolutely clear. Once you are done up with this, then the next step becomes pretty vital. And the next step basically relates to, as I told you, even in the last session, this will be your 4th step, I think so. Right. So under the 4th step, we are supposed to prepare the analysis table. And the basic idea of preparing the analysis table, as I told you, is to know the amount of equity or the net assets of the subsidiary company on the date of acquisition. So analysis table. In order to prepare the analysis table, as you know, here I am going to write, of course, amount, and then parent, and the share of the parent is 60%, and NCI never writes subsidiary company. Sometimes it happens that inadvertently we write subsidiary company. If you also remember the discussion of the last session, correct? I told you when we prepare the analysis table, first of all, always write A and then write on the date of acquisition. Because on the date of acquisition, we are interested in finding out the net assets on the date of acquisition. As you can see, this time the date of acquisition is 30th of September 2021. Now, my first question obviously will be, kindly let me know the amount of share capital. Amount of share capital of subsidiary company on the date of acquisition. And remember, date of acquisition this time is 30th of September. And you have been given share capital of the subsidiary company on the last day of the balance sheets. Of course, the share capital which is given to you is 5 lakh. Now, if you have the things in your memory of the last section, I did talk about this particular fact that as far as share capital is concerned, you need not require to worry about that, because at every stage during the entire accounting year, the share capital amount must be same. Is it clear to you? So safely we can say that even on the date of acquisition, share capital of the subsidiary company must be 5 lakh. So as far as share capital is concerned, it is not going to give us any sort of trouble. Now moving over to the next part. Then here, as you know, we are basically interested in finding out the equity. Equity means net asset, and net assets means share capital plus other equity. Now, as far as other equity is concerned, only one item is their profit and loss account. Now look here into the table very carefully. This is the table. Is it clear to you? In the beginning of the accounting year, correct? Right, Pooja Kumari told me something 119. Yes, I got actually what you are trying to tell. In the last session, I wrote current assets something else. So I think you have given me the current amount. Thank you so much. But anyway, please pay attention here. Opening balance. Opening balance in the profit and loss account is 2 lakh. Correct? If opening balance in the profit and loss account is 2 lakh, please pay attention. And I will also add now that subsidiary company has earned 1,50,000 in the first 6 months. 2 lakh is the opening balance, and subsidiary company has earned 1,50,000 in the first 6 months. So that means on the date of acquisition, balance in profit and loss account must be equal to 2 lakh plus 1,50,000, isn't it or not? So that is the reason actually here when I am going to write profit or loss account, I am going to write it in this manner. First, I am going to write the opening balance. As we have seen that opening balance is 2 lakh. And then I am going to add here the profits earned in the first 6 months. That is pre-acquisition profit. So pre-acquisition profit means the profit earned prior to the date of acquisition. Then prior to the date of acquisition, this entity has earned a profit of 1,50,000. So we can say and conclude that on the date of acquisition, balance in profit and loss account must be equal to 3,50,000. I hope each one of you would agree with me up to this particular point. Is it clear to you? Is it clear to you or not? So on the date of acquisition, now we can say that total equity of this particular entity, subsidiary entity, is equal to 8,50,000. Indirectly, it also means net assets of subsidiary company on the date of acquisition is equal to 8,50,000. Now, you will have to divide it in proportion, that is 60% and 40%. If I am going to take 60% of 8,50,000, I think it will be equal to 5,10,000. Kindly check also. And 3,40,000 will be the share of the NCI. So through this particular table, we can easily find out the proportionate share of the parent and the NCI in the net assets, of the subsidiary company. And now I am going to write here part B. As far as part B is concerned, the title will be post-acquisition equity. Post-acquisition other equity. So post-acquisition other equity. In this question, other equity item is only profit and loss account. And just when we did the analysis over there, we found that in the next 6 months, that means in the post-acquisition period, subsidiary company this time has earned a profit of 1,50,000. So that means I am going to put here 1,50,000. So post-acquisition profit and loss account is actually 1,50,000. Out of 1,50,000, obviously 40% belong to NCI. So I am going to write here 60,000. And 60% will belong to, correct? So 60% will belong to parent company. This is how you will have to prepare this particular table. And even in the last session, I talked about this particular fact. If you are done up with this particular step, that means half the battle is already won. So here we go. And now in the next step, under step number 5, we are supposed to compute the cost of control. Correct? Cost of control. cost of control. Basically, in order to compute the cost of control, what we need? We need the share of the parent in the net assets on the date of acquisition, and we shall have to actually compare it with the amount of the consideration. So now I am going to compute the cost of control within 2 steps, correct? So for that, I am going to write first of all, share of parent, share of parent, share of parent in the net assets or in the equity, whatever you may like to write, in the net assets of subsidiary company of S Limited on the date of acquisition. It is better to write it in full. Share of P in the net assets of subsidiary company on the date of acquisition. So on the date of acquisition, we have already found out that share of parent is equal to 5,10,000, isn't it or not? And then the next thing we need to find out is how much consideration we paid. Consideration. And we know the amount of consideration. What is the amount of consideration in this case? When we were going through the question, I told you that under the asset, 3,000 shares were acquired at an amount of rupees 7 lakh. And this 7 lakh is nothing but the consideration. So we have paid 7 lakh. Against that, we are getting 5,10,000. The difference will obviously be goodwill, 1,90,000. Why it will be goodwill? Because we have paid more than what we are getting. So that is why it will be considered as goodwill. So your goodwill will be equal to 1,90,000. Is it clear to you? Initial stages are there. That is why we have to move with a little bit of slowness, you can say in this case. And then 6th step. What is the 6th step? That is your NCI. And because we have framed the table, now computation of NCI should be very easy for each one of us. In order to compute the amount of NCI, what I need to do? First of all, I will take into account on the date of acquisition. That means what was the value of the NCI on the date of acquisition? On the date of acquisition, we saw earlier in the table that 3,40,000 worth of asset belong to NCI. So I would write here 3,40,000. That means value of NCI was 3,40,000 on the date of acquisition. And then I am going to add here share in post-acquisition other equity. Or simply you can write post-acquisition profit and loss account. Now post-acquisition profit and loss account, you must have noticed, was 1,50,000. Out of that, share of NCI was 60,000. So I'm going to write here 60,000. So that means NCI in the beginning of the year was 3,40,000, but by the end of the year, it has gone to 4 lakh. Is it clear to you or not? Right, sir. So NCI is equal to 4 lakh. After having written the amount of NCI, the only step remaining is balance sheet. Still, why I am insisting upon preparing the balance sheet? Because I just want to inculcate in you the habit of preparation of the balance sheet. Now, consolidated balance sheet we are going to prepare. I am going to write here consolidated balance sheet. First of all, in order to prepare the consolidated balance sheet, first of all, we have to write the assets. Under the asset, if you remember, first of all, we are supposed to write the non-current asset. Now, as far as non-current assets are concerned, most of the items will be written in a line-by-line manner. Most of the items, no doubt about that. Only 2-3 items we have to take care of: investments, share capital of the subsidiary company, and the other equity items of the subsidiary company, if you remember. Correct? So, in this balance sheet, and please kindly pay the attention also, I think the first item was property, plant and equipment. Property, plant and equipment in the balance sheet of parent limited is actually given as 10 lakh, and as far as of subsidiary company is concerned, it is equal to 8 lakh. So 10 lakh plus 8 lakh must be equal to 18 lakh. Is it clear to you or not? Right, sir. We are not going to write the investment, I told you, because investment is already exhausted when we computed the goodwill. So investment will not find place in the consolidated balance sheet. However, you have to be a little bit more careful. Goodwill. And now let me tell you, and it is very important because such sort of mistakes are not expected from a student or professional level. Under Division 2, goodwill is never included under intangible asset. although it is an intangible asset. But goodwill is presented separately. What I mean to say is that suppose if I have to write patents, then first of all I will write intangible asset, then I will write the patent. But in case of goodwill, I'm not going to write intangible asset and then goodwill. I'm supposed to write the goodwill. All other intangible assets will be clubbed, but goodwill will be presented as a separate line item. Is it clear to you or not? So goodwill, which we computed earlier, 1,90,000, you can mention in bracket the step number also. 1,90,000. In this particular question, nothing as far as what we call non-current asset are concerned. Then we come over to the current asset. As far as current assets are concerned, in this particular question, as far as current assets are concerned, what was the amount of current asset? I think it was 5 lakh and 11 lakh, if I am not wrong. And then it comes to 16 lakh. Even if I am wrong, don't worry about that. Point is that we have to do the line by line addition. Whatever total will be there, you simply write it down then. That will be equal to 90, and then 9 plus 6, 5 and 3. That means it will be equal to 35,90,000. 35,90,000 will be the total of the asset side, if I am correct. Correct? And if I am incorrect, I take sorry of you in the beginning itself. Then we move over to the liability side. As you know, under the liability side, we are supposed to write equity and liability. In order to write equity, so after having written equity and liability, then we write actually equity. Equity. As we know that equity encompasses two components, one share capital and other equity. So now I am going to write here A, share capital. As far as share capital is concerned, I told you in the last session that only the share capital of the parent will find place in the balance sheet. And share capital of the parent obviously is 10 lakh. The share capital of the subsidiary company has already been used for computing the what we call net assets, isn't it or not? After this, we are supposed to write the other equity. As far as other equity is concerned, in this case, only there is profit and loss account. Even in the last session, I talked about this particular fact that we should not directly write profit and loss account. We should write consolidated profit and loss account, CPL in short form. In order to write, first of all, I will have to look into the balance sheet. Towards the liability side, in the column of the parent, I need to know what is the amount of what we call profit and loss account. Now, what is the amount of profit and loss account in the balance sheet? I think it is 4 lakh. So I am going to write here profit and loss account 4 lakh. This is the balance. This is the balance of the parent. Remember one thing. Then I am going to add share in post acquisition. Share in post acquisition. Share in post acquisition P&L. Share in post acquisition P&L was 90,000 if you remember. So I am going to write here 90,000. So that means the consolidated amount in the profit and loss account now is equal to 4,90,000. Is it clear to you or not? So this is how you are supposed to prepare the balance sheet. Again, very important item. As I told you in the last session also, that when you will write here NCI, first of all, as a professional student, you need to understand that NCI is always written. NCI is always written under equity, but it is not clubbed with the other equity items. It must be actually presented separately. Amount of NCI, you can also put up your step number later on. Anyway, 4 lakh. And then rest of the item line by line addition is needed. For example, in this case, NCL. If you remember, the amount of NCL of parent I think was 5 lakh and of subsidiary is 4 lakh. So I am simply going to write here 9 lakh. Only line by line addition is needed. Is it clear to you or not? And then I am going to write here current liability. As far as current liability is concerned, I am going to write 3 lakhs. And then I am going to add 5 lakhs. Ultimately, it will be equal to 8 lakhs. And then you kindly total it of your own to know whether the total is coming to 35,90,000 or not, because as far as asset side was concerned, it was 35,90,000. This is how we are supposed to do this particular question. I hope you have understood it quite well and you haven't encountered any sort of what we call problem. Coming over to what we call the next question. Now, as far as next question is concerned, although I have already told you this thing has been given in a solved manner, but what happens when everything is given in a solved manner? Sometimes a student slackens away bit. And that is very dangerous. I'm telling you, due to some or other reason, after some time you can stop writing, that's a different matter. But at least in the initial stages, make a habit. The more you are going to write, the you are going to memorize the steps. It is not as easy as it seems, but at no point of time I'm going to feel that this particular chapter is tough one. 1.3. Now in this case, as I have written over here, we are going to discuss some what we call adjustments. And the prominent among them, in this particular question, I think there is treatment with respect to abnormal loss and unrealized profits. So what sort of these adjustments are and what sort of repercussions and implication they are going to have in the solution. In order to know that, let's have a look over this particular question. Following is the balance sheet of P Limited and S Limited. And this time the balance sheet date given to you is 31st of 3, 2021. Once again, we start with property, plant and equipment 2 lakh and 4 lakh 50,000, and then it is given land 3 lakh and then 6 lakh 50,000. Although I have given some more items, but those item figures are not presented, and it is just to actually tell you that when we are going to prepare the balance sheet in a as per division 2 manner, such items also come under in the balance sheet. So after property, plant, land, we have financial asset, that is investment in 4,000 shares of S Limited. Now this time you must have seen that investment is in 4,000 share and amount paid is equal to 2 lakh. Besides that, we have got in this case inventories to the extent of 2 lakh and 1 lakh. Then trade receivables are there. Later on in the balance sheet, simply line by line addition will be needed for inventories, unless and until there are some specific adjustment with the inventories. Similarly, trade receivable will be done in a line by line manner unless there are some adjustment related to trade receivable. Likewise, cash and cash equivalent 2 lakh and 5 lakh, I am simply going to put the figure by simply adding them. So these are the 3 items: inventories, trade receivable, cash and cash equivalents, which are given to us in the question. You must have noticed that trade receivable, cash and bank balance and loans, they fall under the category of financial assets. Correct? Intentionally, I have written it in this manner so that you derive actually some mileage out of it. And then coming over to the equity and liability, one share is of 100 each, 10 lakh, 5 lakh as usual. So far, even in this particular question, number of share of subsidiary company, it means is 5,000. Other equity item. Now this time you have to pay attention because this time we have got 2 items of other equity. As I told you, slowly and steadily when we are going to pick up the higher range of this particular chapter, we will come across more than 1 item of the equity. So here in this case, profit and loss account and general reserve is given to you. 1 lakh and 2 lakh. Correct? As far as items related to parent is concerned, they are not going to pose us any sort of problem. However, items related to subsidiary company, this is 3 lakh and 4 lakh. Actually, this is 4 lakh. And then we have got in this particular case current liabilities 3 lakh and 5 lakh. After current liability, there is only one more item in the form of current liability, that is trade payables, 1 lakh and 2 lakh. Only one more item is there. Correct? Current liability 3 lakh and 5 lakh, and then we have got trade payable 1 lakh and 2 lakh. After this, it is given in the question. Now, prepare a consolidated balance sheet as at 31st of 3, 2021. Kindly rectify this case, this date, in case if this date is written. I think in your notes it will be okay, but sometime in my notes it is not okay. So prepare a consolidated balance sheet as at 31st of 3, 2021 after taking into account the following. So, first of all, it is given in the question itself that P Limited acquired 80% control, but the control has been acquired in the beginning of the year. This is the important point which you need to take care of. And then further, it is given that profit and loss account balance of S Limited in the beginning, that is on 1/4/2020. Actually, it should be 1/4/2020. Some problem with respect to dates. Because the balance sheet date is 31st 3 2021, you make it 1/4/2020. It stood at rupees 1 lakh, while general reserve balance on the date is actually 3 lakh. That means in the beginning of the year, profit or loss account of subsidiary company was 1 lakh and general reserve was rupees 3 lakh. Now in this question, this transaction which is given to you will be called intercompany transactions, or it will be called intercompany debts, or it will be known as mutual debts. Mutual debts. Mutual debts. correct? Or simply you can say contra transaction, contra transactions, correct? Contra transaction. For example, here it is given trade receivable of P Limited include 50,000 due from S Limited. Generally, intercompany transaction could be related to what we call debtors or bills receivable. The intercompany transactions will be eliminated, And how they will be eliminated? For example, when I am going to write towards the asset side, I am simply going to add the amount of the trade receivable and then I am going to subtract intercompany debts 50,000. Similarly, towards the liability side, I am going to add the amount of the trade payable and subtract 50,000. Indirectly, it means intercompany transaction with respect to trade receivable or trade payable, irrespective of the fact whether it is due to the parent or whether it is due to the subsidiary. We are not concerned with that. Intercompany transaction means the transaction between the subsidiary and the parent company, and such transactions are or shall have to be actually eliminated in the balance sheet, and from both from the asset side and from the liability side. So whatever intercompany transaction will be given to you, the simple treatment is that you will have to simply subtract it from the what we call respective items, both from what we call asset side and from the liability side. For example, this is related to trade receivable of P Limited. It means P Limited is claiming that in our trade receivable, there is an amount equal to 50,000 which we are supposed to actually receive from S Limited. Put it in other words. In other words, it means in the creditors of subsidiary company, there is an amount to the extent of 50,000 which they are supposed to pay to the parent company. So that is why this particular transaction will impact both trade receivable and trade payable, and it will be subtracted from the combined amount later on in the balance sheet. Now, next point is inventories of S Limited includes goods worth rupees 50,000 purchased from P Limited. Now question says that inventories of S Limited includes goods worth rupees 50,000 purchased from P Limited. And P Limited sells the goods at 25% profit on cost. And P Limited sells the goods at 25% profit on cost. What does it mean? First of all, here in this case, what is happening? Inventories of S Limited includes goods worth rupees 50,000 purchased from P Limited. What does it mean? It means that P Limited, that is parent company, must have sold inventory to S Limited worth rupees 50,000. And this inventory must have been sold on credit. How did I conclude it? It is given in the question that parent limited has sold 50,000 worth of inventories to S Limited. And how did I conclude that this transaction must have been on credit? Because earlier it was written that P Limited is claiming that they are supposed to receive 50,000 from S Limited. So it could be possible only if we had sold the goods to S Limited on credit terms. Is it clear to you? So point which you need to note is that P Limited must have sold 50,000 worth of goods or inventory to S Limited. And further it is given that P Limited sells the goods at a profit of 25% on cost. Now rate of profit is given at 25% on cost. So 25% on cost means cost plus profit margin. Cost or margin or profit, whatever you may like to write. Cost plus margin is always equal to selling price. Because rate is given on cost, so I am going to presume cost as 100. Obviously, the margin will be 25 and selling price will be equal to 25. I need to convert the rate of profit on cost to the selling price. So margin will be equal to 25 and selling price will be equal to 125. So that means this rate on selling price will be equal to 1 by 5. It means when parent limited sold 50,000 worth of goods to S Limited, it must have earned some profit. How much profit it must have earned? It must have earned a profit of 50,000 into 1 by 5, 10,000. Try to understand. If P Limited is selling the goods to S Limited, if P Limited is selling the goods to S Limited for 50,000, obviously this is the selling price and the profit rate is 1/5. That means P Limited must have earned a profit of 10,000. Is it clear to you or not? Obviously, if I am going to sell goods to you, I am going to earn some profit and obviously I am going to take that profit to the profit or loss account of mine, isn't it? So P Limited must have taken this profit to the profit or loss account. Now the point is that because we are preparing a consolidated balance sheet, at the time of consolidation, S Limited is telling us that out of 50,000 worth of goods which we purchased from you, now here it is written that inventory of S Limited includes goods worth rupees 50,000 purchased from P Limited. P Limited sells the goods at 25% profit on cost. Because in this particular question, it is written that inventory of S Limited includes. It means S Limited is telling to P Limited that in our inventory, there is an inventory worth rupees 50,000 which we purchased from you. That means the stock of S Limited includes 50,000 worth of goods which were purchased by S Limited from P Limited. Now, because they are doing the consolidation, the P Limited will come to know that if these 50,000 worth of goods were sold by us to S Limited and these goods contain a profit margin of 1/5 and these goods are lying unsold. So logically, I will have to combine the inventory now, both. Are you getting my point or not? So I will have to now combine the inventory. And in order to combine the inventory, what is happening now here? In this particular question, please kindly take attention of this. Actually, point which you need to know is that because we are preparing a consolidated balance sheet and P Limited knows that this inventory which is lying with S Limited is at a selling price. Because it contains a profit element of 10,000, logically its cost price should be 40,000. So we need to include it in the consolidated balance sheet at 40,000. In order to bring it at 40,000, whatever inventory is lying with the subsidiary company need to be brought to cost. So for the same, we will have to eliminate the profit margin from it. And the profit margin is 10,000. So what my point is, first of all, you need to understand that, and later on we will see that it will be known as unrealized profit. This is unrealized profit because the goods which we sold to S Limited, out of that 50,000 worth of goods are still lying with what we call S Limited. So because these goods remained unsold, that is why the profit margin will have to be eliminated. Now later on we will see that as far as treatment of unrealized profit is concerned, number one, this unrealized profit 10,000 later on will be subtracted from the consolidated amount of the inventory. We will add the inventory of the two company and I will subtract unrealized profit so that the inventory of 50,000 comes back to the cost. And second treatment will be from the consolidated P&L, because consolidated P&L basically means parent's P&L. In the consolidated P&L, I will subtract entire 10,000. Why I am going to subtract entire 10,000 from the consolidated P&L? Because this profit was included. This profit was included in the P&L of the parent. This profit was included in the P&L of parent. Earlier, parent sold the goods, and when it sold the goods earlier, it must have included that profit in its P&L. So quite obviously, now Parent Limited will have to actually bring down its profit because of this unrealized profit portion. So later on we will also see that as far as unrealized profit transactions are concerned, unrealized profit will come into play only and only when one entity sells the goods to the other entity. I mean parent sells the goods to subsidiary or vice versa. Even subsidiary company can sell the goods to the parent limited. Correct? And some of those goods must be lying unsold. On unsold goods, we shall have to apply the profit margin. This is the important point which you need to take into account. Is it clear to you or not? This is the point which you need to take into account. Is it clear to you or not? Is it clear? Okay. If it is clear, then we can move further. And one more thing I would love to tell you. As far as unrealized profits are concerned, when P Limited, because out of P and S, we can safely assume that P Limited being a parent company is the bigger. So whenever big company will sell the goods to the lower company, that is in this case subsidiary company, it will be considered as downstream transaction. It is considered as downstream transaction. Is it clear to you? On the other hand, sometime we may come across such a situation that subsidiary company is selling the goods to the parent company. If subsidiary company sells the goods to the parent, that will become a case of upstream transaction. Upstream transaction. Although the treatment of unrealized profit more or less will remain same with slight change in case of upstream transaction that I will discuss later. At this moment, I have discussed only with respect to what we call downstream transaction. A downstream transaction is one wherein parent limited is selling the goods to the S limited, number one, and some of the goods are lying unsold. From the unsold stock, we will have to extract the profit margin, and that profit margin will be subtracted later on from the consolidated figure of the inventory and of course from the consolidated P&L. Is it clear? So this is how we are going to treat this. Further in this question, another important adjustment. So three adjustments we have already come across in this. One with respect to intercompany transaction, another one is with respect to unrealized profit, and here it is written in the month of the June. When the control has been acquired in the beginning, and we know that June always comes after what we call later than April. So in the month of June, goods worth 50,000 got destroyed. So whenever it would be written in the question that goods worth got destroyed, you will first of all you are going to presume it is a case of abnormal loss, unless and until word normal is written. Now suppose in case, because never ever you will come across that there are normal losses, especially under consolidation. In case if you come across a word normal loss, no treatment will be needed. So you shall always presume it to be as an abnormal loss. Number one. First of all, you will have to note down exactly when the abnormal loss has taken place, whether it has taken place in the pre-acquisition period or whether it has taken place in the post-acquisition period. In this case, because date of acquisition is in the beginning and abnormal loss is taking place in the month of the June, so quite obviously we may conclude that abnormal loss has taken place in the post-acquisition period. And further it is given that insurance company admitted a claim of 30,000 only. So indirectly it means the net abnormal loss is 50,000 minus 30,000, that is equal to 20,000. How we are going to treat it, that I will let you know in a short while. So after having gone through this particular question, now let me come to the straight points and start what we call solving this one. Clear? So in order to solve this particular question, as usual, because these are initial questions and I do not want to take any sort of risk, so I want you to get a firm what we call control over the things. So this is, I think, 1.3. So in order to solve 1.3, first of all, under step number 1, as usual, I am going to do the analysis. In order to do the analysis, first of all, I am going to write the dates. I think in this particular question, dates are 1/4/2020, beginning of the year, and end date is 31st/3/2021. Correct? This is the end date, 31st/3/2021. Clear? And because here it is given in this question that date of acquisition is also in the beginning, so quite obviously the entire accounting period will be considered as post-acquisition period. Now we come over to the second point. As far as second point is concerned, we know it is related to degree of control. And we have already seen that total number of share of the subsidiary company is 5,000, 5 lakh divided by 100. And in this question, we have also seen that 80% shares, and in fact, in absolute terms, it is also given under investment that 4,000 shares are in the hands of the parent, while it means 1,000 shares are in the hands of the NCI. So in this case, ratio will be 4:1 or 80%, 20%. So next step, as usual, we are going to do the analysis, and the analysis as far as is concerned in this particular question, you will have to do the analysis of P&L and of course of general reserve. So analysis of, first of all, I am going to do the analysis of profit and loss account. In order to do the analysis of profit and loss account, as usual, we are going to note down carefully the closing balance and the opening balance. As per the balance sheet, we have already seen that closing balance of subsidiary company as far as profit and loss account is concerned, that is equal to 3 lakh if I am not wrong. And as far as opening balance is concerned, below under adjustment number 1, it was written that opening balance of profit and loss account was 1 lakh. Now we can take the difference of these two items. After having taken the difference, we find out that subsidiary company must have earned a profit of rupees 2 lakh during the entire accounting period. Correct? Here, you will have to stop for a while. In case if in the question there is an adjustment related to abnormal loss, first of all, what you are going to do, you are going to add the abnormal loss to this profit. And it is always better to add the net abnormal loss. 50,000 minus 30,000. So 20,000 is your net abnormal loss. You are going to add it to during the year profit. Purpose, why we are adding it? The reason being is that we want to know if this particular loss would not have taken place, what would have been the profits in the entire accounting period. So in order to know that figure, first of all, we will have to add it. So that means 2,20,000 is our during the year profit, we can say before charging the abnormal loss. Is it clear to you? After having added the amount of abnormal loss, now you are going to segregate the amount into pre-acquisition and post-acquisition. Correct? So in this case, now I am going to segregate it pre-acquisition. First, let me write pre-acquisition, then I will write here post-acquisition. Unfortunately or fortunately, in this case, there is no pre-acquisition period. All these profit relate to post-acquisition period. So we shall write here 2,20,000. Is it clear to you? Abnormal loss, treatment. I have written all these treatment in the notes also. Don't worry. I have kept a separate section where I have written all that respective treatments. So first of all, try to pay attention. Abnormal loss, first of all, will be added to the during the year profit. Reason, we want to know if this particular loss would not have had taken place, what would have been the amount of profit during these 12 months. Once you have added back, then look very closely the point of time at which abnormal loss has taken place. In this particular case, abnormal loss has taken place in the post-acquisition period. If it has taken place in the post-acquisition period, now you will have to subtract it from this part's profit. That means the portion of the profit related to post-acquisition period. Now I am going to write here less abnormal loss. Some of you might wonder, sir, once you are adding and once you are subtracting, so net effect might be same. No, net effect will not be same. For instance, let us say, as per your version of thinking, if I am adding once and I am deducting once, so I should not have done anything. As per your version, I would have had divided entire 2 lakh worth of profits, isn't it or not? So my point is that this is not the situation. The point is that we want to know everything, because from the accounting perspective, we have to reflect what amount of profit we would have had earned, number one. And the basic idea of subtracting then from pre or post portion depending upon the time when the abnormal loss has taken place. For example, if abnormal loss would have taken place in the pre-acquisition period, I would have had subtracted it from the portion of the profits related to pre-acquisition period. So the idea behind is that we want the brunt of the abnormal loss should be borne by the period in which the abnormal loss has taken place. If abnormal loss has taken place in the post-acquisition period, so the entire brunt of the loss should be borne by the post-acquisition period. Is it clear to you or not? So when we are going to make the table later on, especially for analysis table, remember one thing, I will take over their post-acquisition profit as 2 lakh. Is it clear to you or not? So what is the treatment of abnormal loss? Number one, first of all, it will be added to the during the year profit. Number two, the treatment now depends upon the fact whether abnormal loss has taken place in the pre or in the post. If it has taken place in the pre period, subtract it from pre portion. If it has taken place in post period, subtract it from the post portion. So as far as abnormal loss is concerned, fine. Now, after having done the analysis of profit or loss account, now in this particular case, we are supposed to do the analysis of general reserve also, because in this question, general reserve is also there. So in order to do the analysis of the general reserve, again, I will take into account the closing balance and the opening balance. As per the balance sheet, balance in general reserve of subsidiary company is 4 lakh. And below, when we read the first adjustment, over there it was written that balance in the beginning was 3 lakh. Is it clear to you? Again, now I am going to see the difference. If I am going to see the difference, I will come across this particular fact that difference is actually 1 lakh. This 1 lakh suggests that subsidiary company has transferred to the general reserve 1 lakh rupees during these 12 months. During these 12 months, subsidiary company has transferred to general reserve 1 lakh rupees. Again, although it is not needed, but you must make a habit of segregating this amount. Although that's a different point, that in this particular question there is no pre-acquisition, so entire 1 lakh will be considered as having been transferred to general reserve in the post-acquisition period. 1 lakh we shall write over here. Is it clear to you or not? Right. So after having done the analysis, as you know, the next step basically relates to the analysis, and analysis table I mean to say. And this is one of the formidable and most important step, analysis table. Because how correctly you have made this particular table will also become a sort of what we call way line for you later on to compute the cost of control and later on NCI. So first of all, I'm going to write here the amount. After having written the amount, I will write here P Limited and of course the NCI. This time their respective shares are 80% and 20%. Don't let it skip out of your memory. As usual, first of all, I'm going to write here A. Under A, first of all, I will write on the date of acquisition. On the date of acquisition, why? Because on the date of acquisition, we intend to know the equity. So first of all, I'm going to write here share capital. Now you let me know. First of all, logically, I should not ask you this particular question, 5 lakh. Although in the balance sheet, share capital is given at 5 lakh, but in spite of that, we shall always presume that share capital in the beginning of the year must be equal to 5 lakh. Then after that, I am going to add here other equity item. As I told you in this particular case, as far as other equity item is concerned, one is profit and loss account, correct? And profit and loss account in the beginning, because in this particular question, date of acquisition is in the beginning. So in the beginning, as we saw when we were doing the analysis, we saw that balance in profit and loss account was 1 lakh. So I will simply write 1 lakh, the opening balance. And similarly, the general reserve in the beginning was 3 lakh. So I am going to write general reserve 3 lakh. So share capital plus reserves and surplus gives us what we call equity. So we may add it now. It will be equal to 9 lakh. So 9 lakh reflects that net assets of subsidiary company in the beginning of the current accounting period is equal to 9 lakh. Now we can take 80%. Acquisition, other equity. Post-acquisition other equity. So in order to write the post-acquisition other equity, we will have to take into account the post-acquisition general reserve and post-acquisition P&L. So first of all, I am going to write here post-acquisition P&L. We saw earlier, post-acquisition, during the year, profit was 2,20,000. We an entire 220 related to post-acquisition period. Then we subtracted abnormal loss. We found that 2 lakh. And at that time, I told you while preparing the table, we will consider 2 lakh. Is it clear to you? I will show you so that there is no confusion at all. This is the amount I have taken as far as post-acquisition period is concerned. Now, out of 2 lakh, 1 lakh 60, that is 80% relate to P-limited. And obviously, then I am going to write here 40,000. I am going to write here 40,000. Is it clear to you or not? Just hold on. Just give me a second. Sometimes there are urgent calls. Hello? Right. हाँ बोलिए कौन बोल रहे हैं अरे राकेश जी राइट नाउ एक्चुअली आई एम इन द क्लास ना मैं लाइव सेशन में हूँ सर मैं अभी आपसे बात करता हूँ मैं अभी आपको फोन कर थोड़ी देर में करता हूँ श्योरली आई विल टॉक one of my old friend actually contacted me anyway. So 2 lakh is the what we call balance, profit or loss account. Post acquisition 160 and 40 are the respective share. Now could you tell me in this particular question, do I need to write any other balance as far as other equity is concerned? Yes sir, general reserve, right? Post acquisition general reserve, it means we saw earlier in this particular case that in the during the year subsidiary company has transferred I think 1 lakh rupees to the general reserve, isn't it? If I am not wrong, right sir? And out of 1 lakh, obviously 80,000 will belong to the parent and 20,000 will belong to the NCI. So once we are done up with this particular step, this is step number 4. The remaining step is with respect to what we call calculation of goodwill or gain on bargain purchase. And in order to compute goodwill or gain on bargain purchase, what we are supposed to do, simply we have to compare the share of net assets of the parent on the date of acquisition with the amount of consideration. So I simply write here parent share of net assets, parent's share of net assets, parent share of net assets on the date of acquisition, parent share of assets, net assets on the date of acquisition, correct? So we saw earlier that as far as share of parent is concerned, that is equal to 7,20,000. That is equal to 7,20,000. And now we are going to compare it with the consideration. If you remember the amount of consideration in this particular question, what was the consideration? I have forgotten the amount of consideration in order to acquire 4,000 share. How much amount did we pay in this particular question? I think it was 5 lakh. Kindly correct me if I am wrong. Well, presuming that consideration is 5 lakhs. So in this particular case, 2,20,000 will be goodwill or gain on bargain purchase. Because share of net asset is 720. Amount of consideration 5 lakh, presuming it is correct. So 2,20,000 will become our gain on bargain purchase. Is it clear to you or not? Because this time the share of net asset is exceeding the amount of, thank you so much, Mahesh Jadhav, who corrected me, it is 5 lakh only. So 5 lakh, 2,20,000 will be your gain on bargain purchase. Is it clear to you or not? So after having completed this particular step, now we can move over to the NCI. Time and again, I do not want to remind you. The moment you are going to leave the session, you will also, it means, leave the chance of recapping the things. Remember one thing. So point is that henceforth it is imperative for each one of you to watch the session in one go, as I cautioned you even in the last one. NCI now. NCI on the date of acquisition, first of all, you let me know. On the date of acquisition, the amount of NCI is equal to how much? As we computed, I think it was 180, so I need to write 180. And after that, all I have to do is simply add post-acquisition share. Post-acquisition share. See here, you can write separately. For example, you can write in this manner. Post-acquisition share in profit and loss account 40. And you can also write post-acquisition share in general reserve. Or simply you can add both these two items to save the time. Correct? You can simply write post-acquisition share in other equity 60,000. So post-acquisition share in other equity is 60,000. So I will write here 60,000. So this means 2,40,000 will be the NCI on the reporting date. The NCI on the reporting date will be equal to 2,40,000. Is it clear to you or not? Now the next thing is that we are supposed to prepare the balance sheet. I do not want to waste your time. I will simply go through the solved balance sheet and I will explain all of it as I told you, and the intercompany transaction. This is the only area which we need to take care of. So coming over to the balance sheet, let's have a look over here. Here we go. This is the balance sheet which I have already framed. And now the basic idea, you know how to prepare the balance sheet. The property, plant and equipment item 2 lakh plus 4 lakh 50, 650. Lands, we are simply going to do the line by line addition. Investment will not figure. This time there is no goodwill. Further, as far as current assets are concerned, under the current asset, we have inventory. As I told you, first we are going to add the inventory of the respective companies, that is equal to 3 lakh. So consolidated amount of inventory is 3 lakh. And the unrealized profit of 10,000 will be subtracted. So 2,90,000 inventory will find place in the outer column. Coming over to the trade receivable. Now trade receivable, as you can see, is 3 lakh and 2 lakh. I told you there is intercompany transaction related to what we call debtors and creditors. And intercompany transactions are very easy to deal up with. And moreover, with such transaction, you are already familiar with. So 50,000 I will subtract. So 3, that is 3 plus 2, 5 lakh minus 50,000, 4 lakh 50. And this 50,000 later on will be subtracted from trade payable also. As far as cash and cash equivalent is concerned, simply add. So total, just check it also, 30 lakh 40,000 should be there. And then as far as share capital is concerned, find 10 lakh. Coming over to the other equity item. In the other equity item, I have told you now several times that first of all, you will write consolidated P&L. You will take the balance of the P&L of the parent company which is appearing in the balance sheet, 1 lakh. Now, to this balance, you are going to add the share of the parent in the profit and loss account. Now, post-acquisition share, that is post-acquisition share in the P&L is 1,60,000. And see here, I have subtracted here unrealized profit also. Why we have subtracted? Because it was parent limited which had sold the goods. And earlier it must have included the amount of profit in its profit. So that is the reason now unrealized profit will have to be subtracted from the consolidated P&L. And in the outer column, we shall write 2,50,000. Clear? Is it clear to everyone? Likewise, consolidated general reserve. First, we will take the general reserve balance of the parent company as per the balance sheet. And only thing is that now you will have to add the share of the parent in the post-acquisition general reserve. The post-acquisition general reserve was 1 lakh. Out of that 80%, 80,000 was our share. So we shall add 80 to 2 lakh and 2 lakh 80 we can write in the outer column. Because in this question there is gain on bargain purchase, you must not forget to write it. Correct? And then I have been tired of telling you that NCI will always be presented as a separate line item. Now coming over to the non-current liability. In this particular question, 3 lakh, 5 lakh non-current liability is simply line by line addition. Coming over to what we call in this case current liability, there is only one item, trade payable. Only thing which you need to take into account is simply add the item, subtract the intercompany transaction. You can write intercompany debts, you can write mutual debts, you can write word contra and subtract it right in the outer column. This is how we are supposed to move in this particular chapter. So today, as far as this particular session is concerned, you must have noticed we have talked about intercompany debts. We talked about abnormal losses, although we will continue with these adjustments and we are going to pick up many new adjustments. Basically, under section 1, we will try to clarify all the adjustments before we take the questions of really high range, as I told you. So this is how we are going to move about as far as this particular chapter is concerned. But only request is when our notes will be uploaded in the no. This particular chapter notes will not be uploaded, Abhijit. You will have to buy the books. You will have to buy the books. Remember, only thing is that we can simply upload only what we call by the business combination. So that is the reason you need to understand. We are going to cover the full course. We cannot, you must understand all these things. We have protocols, agreement with our sites, with our publications. So that is the reason which actually sometimes becomes constraining factor. I hope you must understand our predicaments. If you have applied for the books, you must have received it by now. And those who haven't yet received the books will receive shortly. We have, on our part, we have sent the books to each and every one. Correct? How many among you have received the books? First, let me know that. How many among you have received the books? Those who have applied for the books, how many among you have received the books? How many among you have received the books? The next class, obviously, I'm going to take again and at 8:30, obviously. Somebody asked from the SES. That's right. So you have received? Good. Brahma Madhu says received. Madhu says received. So 4 volumes you have received, isn't it or not? And how did you like the books actually? Say still I did not receive Veera Bhai Podavudi. Yes, I remember the book has already been sent and you must have been given the what we call your that number, tracking number. Don't worry about that. It will reach you shortly. Any other? Yes, so most of the students have received, and those who have applied it later, definitely they will receive. As I told you, we have already sent all the books and we have almost given to each and everyone the slips, your tracking number also. So kindly show a little bit of patience. If anyone hasn't yet received, don't worry about this. And in the meantime, if you are not going to receive the books, correct? If you haven't received the books, what you will do, you can contact the help desk number. Tell them, sir, we haven't yet received the book. Kindly give us the notes of the consolidation. Correct? You got my point? In case if the call is not picked up, simply write your name so that at least you do not lose out on the things over here. Okay, then on such count, we take leave of you. Hope this particular session must have come up to your expectations. And on such count, as we also would like to have your feedbacks as always, and surely would meet you in the next session at same time with equal zeal and enthusiasm and energy. Okay then.